All right, today we're going to crack open one of the most powerful tools for any investor out there, the annual report. But we're not just going to read it. No, we're going to treat it like a detective's case file. It's packed with clues that, if you know how to look, tell you the real story behind a company.
Now I get it. You open one of these things up and it's 100+ pages of dense text, jargon, and tables that seem to go on forever. It can feel, well, pretty intimidating, right? It's totally normal to feel a bit lost at first. But trust me, it's way more approachable than it looks.
Because here's the secret. This document, it's the single most important tool you have in your arsenal. Seriously. Forget all the noisy news headlines and the day-to-day market chatter. The annual report is your direct line, your unfiltered source of truth that can really make or break your investment decisions. So, here's our game plan for this little investigation. First, we'll establish why the annual report is your most trusted source. Then, we'll listen in on the management story and learn how to spot the clues between the lines. After that, we dive into the hard evidence, the numbers. We'll also untangle the difference between standalone and consolidated figures, super important. And finally, we'll connect all the dots to get the full picture.
Okay, first things first. What even is an annual report, and why should you trust it more than anything else you read about a company? Well, think of it as the company's official, once-a-year publication sent out to all its shareholders and anyone else who's interested. And this is not some glossy marketing brochure, okay? The numbers in here have been certified by independent auditors. That means someone has checked their work. And here's the kicker. If a company misrepresents the facts in this document, they can be legally challenged. That's a huge deal. It makes this the most reliable information you can get because it's straight from the horse's mouth, and there are real consequences if they lie.
Okay, so we know we can trust the report. Now let's move on to the more narrative part. This is where the company's leaders, the CEO, the chairman, tell you their story. It's your chance to get a feel for their vision and their strategy. But this is also where your detective skills really need to kick in.
You got to be careful here. There's a really fine line in these reports between cold, hard facts and, the shiny marketing fluff they want you to believe. Your job as a detective is to learn how to tell the difference, to find the substance hiding behind all the style.
So where do you start? To get the inside story from management, I always go to two sections first. You've got the management statement, sometimes called the chairman's message, which gives you that high-level, big-picture view. Then you have the management discussion and analysis, or MD&A. This is where they get into the nitty-gritty. These two sections are absolute gold mines for insights.
Let me give you a perfect example of how to spot a red flag. The source material talks about a tea company. In the chairman's message, he was all excited, talking up a big game about hitting 10% revenue growth. But a quick peek at their own data from past years showed the company's growth was really only about 4 to 5%. You see that disconnect? That's a huge clue that management's promises might be a little out of touch with reality.
The MD&A is actually pretty easy to follow because it usually has a logical flow. It starts big picture with what's happening in the global economy. Then it zooms in on their specific industry. After that, they review how their business actually performed. And finally, they lay out their strategy for what's next. As you're reading, just keep your eyes peeled for vague promises or if they're always blaming external factors for bad results. It's a whole story right there for you to analyze. All right, we've heard the story they're telling. Now it's time to check the evidence. Let's get to the heart of the annual report, the financial statements. This is where the narrative gets a reality check because, well, the numbers don't lie.
There are three core statements you've absolutely got to know. You've got the profit and loss, or P&L. This tells you, flat out, is the company making money? Then there's the balance sheet, which is a snapshot of its financial health, what it owns versus what it owes. And finally, the cash flow statement. This one is key because it shows you where cash is actually coming from and where it's going. Together, these three paint the full financial picture.
Now hold on. Before we go any further, there is a super critical distinction we have to talk about. When you're looking at these financial statements, you're going to see two sets of numbers, standalone and consolidated. Honestly, ignoring this difference is probably one of the biggest mistakes a new investor can make. So what's the deal? Well, standalone numbers just show you the performance of the main parent company itself. But a lot of big companies own smaller companies, which are called subsidiaries. Consolidated numbers roll everything up, the parent company and all its subsidiaries into one big report. Let's use a real-world example to make this crystal clear. Take the rating agency CRISIL. CRISIL is the parent company, and it owns 100% of another company called IREVNA. So IREVNA is its subsidiary. Pretty simple structure, right? Now check this out. Let's say, hypothetically, that on its own, on a standalone basis,
Crystal had a massive loss of 1,000 crores. Yikes. But its subsidiary, Irevna, had an amazing year and made a profit of 700 crores. So when you consolidate them, you combine that loss and that profit, suddenly the total loss for the whole Crystal Group is only 300 crores. That is a dramatically different story, isn't it?
And that right there is why this is so important. You should almost always focus on the consolidated numbers. They give you the true, full financial position of the entire operation, not just one piece of the puzzle. It is the only way to see the complete picture.
We're almost at the end of our investigation. The very last step is learning how to dig one level deeper. The main financial statements give you the big headline numbers, but what if you want to know exactly how they got to a certain figure? Well, that's where the schedules come in. Okay, take a look at this little snippet from a real balance sheet. You see the line for share capital has a value of about 17 crores. But look closer. See that little column that says Note No 2? That's your clue. It's literally a signpost telling you, hey, for the full breakdown, go to schedule number 2. And here it is. You follow that signpost to note number 2, and you see exactly how they calculated that share capital number, detailing all the authorized and issued shares. Every single line in the main financial statements has a little note like this. It lets you trace every number back to its source. It's all about transparency. So let's recap our detectives checklist. Number 1, the annual report is your most reliable source, period. 2, read the MD&A to get the story and look for clues. 3, use the 3 main financial statements as your hard evidence. And finally, number 4, always, always, always use the consolidated numbers to see the whole truth. And there you have it. You now have the basic framework to pick up any annual report and start decoding it. You can separate fact from fluff, the story from the evidence, and the partial view from the full picture. So the only question left is, what's the first case you're going to crack?